Hi everyone, Dan Benson here with Beacon Capital Management. Today we're going to talk about the 3 roads of retirement. And whether you know it or not, each one of you today are on one of these roads. And what I want to help you do is to be able to identify which road it is that you're on, and then also help you understand if that is the correct road to get you to your retirement and or through your retirement, depending on the stage of life that you're in. So to begin with the one that most of you are going to be more familiar with, we call it the Investment Interstate. And what the Investment Interstate is typically an investment strategy handled through a broker or a brokerage firm that really preaches diversification, where they build a model for you and it may have stocks, bonds, mutual funds, different levels of risk within there, large cap funds, small cap, international. But essentially 100% of the portfolio is dependent in some capacity on the stock market. And while I do believe that this is a great road to get you to retirement, I'm not sure if it's always the best path to get you through retirement, because if you look around, a lot of us that are on the Investment Interstate today, in the last 30 days, 3 years of our earnings have just been eliminated. And if you go back even further to the 2008 crisis, those that were invested in what would be considered a moderate type of risk, even in the year 2008, a 60-40 split portfolio still lost 35 to 40%. And so the Investment Interstate, it rides fast, it rises fast, right? The last 10 years have been pretty incredible when it comes to performance out of the market. But as quickly as it rises, it falls much faster. And it takes much longer to recover. And the one thing you don't have once you get to retirement anymore is time. We don't have time to let things recover. We're counting on the money now. And so we believe that a portfolio that has 100% of the money in the market, even diversified with bonds and things like that, if you just could lose 30 or 35 to 40% of your portfolio in 1 year in your retirement, is that too much risk? Would you be comfortable with that? And I can tell you, the folks in 2008, some of the people out there right now, they're not comfortable with that level of risk as it relates to all of their money. I would agree, for retirement, that does carry too much risk. The risk is too high. So what a lot of people do when they're on the Investment Interstate and maybe they experience losses or an uncomfortable amount of losses as they get closer to retirement, or they're already in retirement, they shift to the opposite extreme. And that extreme is what we call the walking trail. That's typically done through banks or bankers, where you have lost money, and to help prevent further losses, you take everything out and you move it over and protect it, put it in CDs, money markets, things like that. FDIC Insurance covers us up to the certain amount of limits. And while the money is safe and the money is protected, if we're only earning 1 to 3% right now, and interest rates are continuing to go down, even if you're lucky enough to get 3%, most are probably getting 1 to 2%, there is a risk out there. It's not risk to your principal per se, but it is inflation risk. Are you going to be able to keep up with the rising cost of goods in this country? Well, if inflation is 3 or 3.5% and you're earning 1.5%, we're losing money each and every year. And this is an allocation that I believe really at any stage of life has too low or not enough risk on the portfolio. And so then there's a third path, and that third path is what we call the bike path. Okay, what the bike path does is it marries an investment strategy that has too much risk for retirement and blends it with a strategy that has not enough risk in retirement to create appropriate balance to get you to and through the retirement. So let me explain this a little bit further. So in the bike path, what it does is it helps you transfer some of that risk. We don't have all the money at risk in the market. You can transfer that risk into different asset allocations that aren't all correlated to each other, so that not everything is moving in the same direction all the time. So we want to transfer some of that risk. The second thing you want to do is know your risk score. Get a risk assessment, as we just mentioned. If you haven't had a risk assessment in your life or recently, the last 30 days just gave you your risk assessment. You can look at your investments and see how much money have we lost in the last 30 days, and if that continued to happen, would we be comfortable with that amount of risk? Now, there is a better way. There are ways to get actual risk assessments to know before something happens exactly what to expect from your investments when things are going up or down. And I believe that's the more appropriate way to actually get a risk score. You want to be proactive with your investments. Unfortunately, so many people are reactive, and it's because they don't know what they don't know. The bike path really tries to help you understand all of these different things that are out there. Risk levels, understanding risk, and then also the third thing that it does is helps us create a written plan. I don't know about you, but I want a written plan. I believe in writing things down. You write things down, things happen. And so when it comes to retirement, the number one and most fundamental thing you want to plan for is income. It's the foundation of everything that you do. You need a written plan for income. You need to look at all the different Social Security strategies that are out there. Work with somebody who knows that. How to draw and when to draw the pension and what options there. And then more importantly, for most families, even with Social Security and pension accounted for, they're going to need some additional funds that are out there. And I don't know about you, but I want to know that my income and that income gap, that money is going to come from things that are predictable, reliable, sustainable through any kind of market condition. And again, it begins with working through a plan, writing those things down, and truly understanding how to have predictable income through the retirement, having a written income plan. Secondly, it looks at principal protection. I don't know about you again, but in retirement, I don't want 100% of my money at risk. I want to know that there's some money out there that is principal protected, that when the stock market's going down, it's not going down, can't lose a penny when the stock market goes down, trying to help keep our head above water. And I can tell you that a lot of people out there today that planned proactively, that have principal protection, they don't feel so bad today. They're glad that they planned appropriately and they understood what true risk looks like and had a plan for that before something happened, not after. I fundamentally believe that you need to have some money protected as you get closer to retirement or through retirement. That's what that bike path accounts for, is having a written income plan, having a written plan for principal protection, and then thirdly, having a growth plan, a written growth plan, again, to help us understand the risk that's out there. We need our money growing to fend off inflation, and we believe in being in the right funds at the right time. How do you know that? Well, it begins with working with a planner that understands the bike path and how that impacts you in your retirement. And so I hope today that you found the information valuable, that you can truly understand which path you're on. If you're not on the right path, identify the one that's right for you. If you have any questions, feel free to reach out to us on the web. Call us anytime. Again, Dan Benson here with Beacon Capital Management. Stay well, be healthy, and until next time, have a great day.